What's up, guys? Welcome to another episode of The Big Break Show. Now, today actually marks a very special day for me. Big announcements. I'm going to be going solo on the podcast, hence why I'm here today talking to you guys about what's coming forward. So, due to a lot of scheduling conflicts, things going on, Dan will no longer be my co host. He's got a ton of stuff going on out in Carolina Beach. I got a ton of stuff going down in California. I'm currently in California. I still live in Carolina Beach part time. However, due to that, it's made it very difficult to pump content out for you guys and to be able to meet up and schedule content for you guys. So we've decided that going forward, it'd be better if I just go at it alone and try to give you guys as best information as I can around short-term rentals, lifestyle, the market, demands, all that stuff, things I do, things I practice in my day-to-day. So today I'm recording this episode to kind of give you guys a little bit of an update of where the podcast is going to go, how we're going to handle it, and give you guys a short-term rental market update going into 2026. So hang around. It's going to be a short episode. And as always, I love you guys. So number one, I am actually going to be posting these videos on my personal YouTube going forward. For those of you watching, you can see here on my screen behind me. Since I'm going at it solo, I'm just going to go ahead and put it on my YouTube channel. It's not to promote my YouTube channel. If you guys like it, follow it, subscribe to it. You know, the usual, hit the button, the like button, all that fun stuff. But it makes it easier for me to keep everything in my brand in one personal location. So we're going to have a separate folder for the Big Break Show podcast going forward. This is going to mark episode 1 of me going at it solo. It's going to be kind of fun, actually, because this is the first time I actually I've done an interview by myself before. I think I did Rich Summers on the Big Break Show by myself. So for those of you that are listening to it under the Big Break Show brand, it's not going to change. It's going to stay the same. However, going forward, they will be posted on the YouTube channel, on Spotify, and everywhere else. You'll still listen to it under the Big Break Show. This is just to keep everything branded under one spot on YouTube itself. So, number 2, I'm going to be doing things a little bit different. We are going to pump out an episode once a week. I'm going to try to do more. However, I'm going to be putting out a lot of market updates around the real estate world and around the business buying world, which is what I'm immersed in. As I've told you guys before, I want to teach you guys and talk to you guys about stuff in my experience and things that I'm curious about. So I'm going to be continuing the lifestyle, the real estate, the short-term rentals, the mid-term rentals, because I know that's the super hot topic right now, and around business acquisitions and scaling and growth. And again, back to a lot of mindset. I'm still a big believer in a lot of personal growth, and I'm going to continue that journey because you can never stop growing, right? So hopefully it doesn't change for you guys. Hopefully you guys are still enjoying the show. I know it's been probably 7 months since we dropped an episode. So it's been quite some time, and I want to keep it consistent for you. I want to help you guys as much as I can. And for those of you that have stuck around, I appreciate you a ton. Honestly, I love you guys. I do this for you guys. I do this because I like to learn, and I want to interview smart people out there that I can learn from. And you guys might as well learn in the midst of me learning. I can put it out and pump it out as content for you guys to continue for your growth journey. Now, one thing I do want to say, ever since I started the podcast, the entire idea was to have someone with me so that we can have 2 different personalities. It's always fun to bounce ideas. So if anything does feel a little bit awkward or uncomfortable, I am open to feedback. I love feedback. If you guys think it's boring, if you guys don't like it, if there's something specific that you guys want to learn about, leave a comment below, shoot me an email. The email's still the same. I'll put it in the show notes below. And if there's anybody specific you want me to interview, I will do so. We're going to be doing virtual and in-person interviews. I know for the last couple with Dan, we were doing all in person, which is why it became difficult. But I travel a ton. I do meet with a lot of really successful real estate investors and entrepreneurs, and I could always use some feedback in terms of what you guys want to learn. So with that being said, if you like the show, please subscribe to it. Please like it. Please share it with a friend. I know this is a big, long intro here. We're to 10 minutes into me telling you guys what's going to happen. But the idea here is to be able to give you guys the best information from my head to yours in a public format, right? In a social media format. So let's shift a little bit and talk about the short-term rental market, the things that I've seen over the past year, how I've shifted my business, the things we're doing differently, the ups and downs. Holy cow, I'm going to make an entire episode of the ups and downs that I've had over the past year. I'm going to make an entire episode on business relationships, how to structure good partnerships. I've had some really great partnerships and some really bad ones and some in-between ones. And I'm an open book. I'm going to talk about all the good, all the bad. And hopefully you guys can learn from it. I know you've gotten a ton of questions about how to structure partnerships, and that's something that I absolutely want to talk to you guys about. Not today. So 2025, how the market shifted over the past few years. Now, I took some notes here, so if you guys see me reading, I apologize, but I want to make sure I give you guys all of the best information possible. Again, based on what I've seen, based on what I'm doing on my day-to-day business, right? Number one, AI. Artificial intelligence has significantly changed the way that people are doing business, the way that people are approaching subjects, the way that people are approaching topics and doing business in the real world. And it's true for short-term rentals as well. Number one, we have implemented a ton of artificial intelligence software into our short-term rental business for messaging, AI agents, automation, even the way I approach my team meetings, all of that. I'm going to make an entire episode around AI just specifically for that. I don't want to talk about that today, but AI, if you're falling behind for artificial intelligence and the way you're doing business, you're not doing very well. So let's talk about the shift over the past couple of years. So post COVID, travel demand did come back super hard. Everyone was getting into the short-term rental market to make more money. This caused saturation and increase in home prices. Now, what that means is a lot of people got into it and the competition was fierce and people were outbidding each other to try to acquire the right property to be able to run a short-term rental. Now, due to that, if you fast forward to today, the short-term rentals kind of stabilized and cooled off to pre-COVID days. So when people were going in and buying properties post-COVID to try to get into the short-term rental space, rightfully so, as short-term rental investors, as entrepreneurs, we tried to find opportunity, and short-term rentals was the hot opportunity at that time. You could put up a bed, and anybody and everybody would book that home because people were eager to get out post-COVID and travel, and so the nightly rates were through the roof. Well, today things have stabilized and cooled off to pre-COVID days. That basically means that nightly rates are back to the normal and people aren't overpaying because now people can travel outside of the country. They're looking for different experiences, more experiential stays than just a place to stay or travel to in their local market. And so for the first time, supplies actually outpace demand. There are a ton of houses being put on the market currently due to that. I'm in some markets right now where we're seeing properties drop over $100,000 in value because people can't offload them fast enough and they're just not making enough money on their nightly rates to cover their mortgage cost. And people just aren't traveling like they used to. Investors are having a harder time entering the short-term rental market because of that. The problem is that if you go and underwrite a property at a specific rate, the nightly rate just isn't meeting that demand or that monthly payment that people are having for that specific property. So if I go and buy a house for, let's say, $800,000 and my monthly mortgage is $6,500 and the nightly rate ends up being $200 at, let's say, 60% occupancy, you're not going to make the money needed to cover that mortgage payment plus your operational costs. And so it's making it harder for people to enter the short-term rental market. Now, on the flip side, it actually makes it easier for people to enter the short-term rental market because people are price cutting really hard. If you can find the right property in the right market, you can probably get a really good discount on that property. You just got to be very careful where you buy and where you're looking. So, due to current market conditions, interest rates are high. There's higher borrowing costs. When interest rates were at 1 or 2%, 3%, you could get the same house at a much lower monthly payment because your cost of debt was significantly cheaper. Well, now the cost of debt is extremely high because you're looking at 7.5, I think 6.75 as of today. And so your monthly mortgage is higher because of that cost of debt. There's higher property prices. The increase in home prices just means fewer investors are jumping into the short-term rentals. Now, again, this is very market specific, guys. The markets that I've seen that are being undercut are those very heavy saturated markets in heavy vacation rental locations that there's just thousands and thousands of inventory and of property, and the competition is just fierce. And so people are cutting market prices to incentivize other investors to get in. I'd just be very careful around those locations. Make sure you're underwriting correctly. Talk to other investors. Don't just go based off of AirDNA data or whatever you find online. Talk to people in that market. See how they're doing. See how they're investing. What are they doing differently to make sure that you're making a good, sound decision? Now, there's also tighter local regulations, right? A ton of cities are introducing restrictions. They're limiting how many new listings can enter the market. I actually went through a huge hit on this in the beginning of the year. The city of Santa Ana banned short-term rentals. I've been very public about it. I think it's a stupid move. They're losing millions of dollars in revenue per year. But, you got a bunch of stubborn city officials that don't really care. And, they're out of office in a couple of years and they move on with their lives. And so, unfortunately, city regulations is cutting people out. Now, I'm all about city regulations. Don't get me wrong. I think city regulations are a great thing if they allow them and they implement some sort of permit process for us to pay taxes and be able to operate legally and ethically within cities. I think outright bans is dumb. I think the city takes a huge hit in revenue. I think hosts take a huge hit, and it just causes people to shut down. We've had to close about 40 different locations, and it's just hurt us tremendously in terms of revenue, cash flow. We've had to get rid of some people and really focus our strategy in different ways: midterm rentals, long term rentals, etc. I want to talk about the metrics in terms of not just due to market conditions in terms of home prices, but market conditions in terms of the way people are traveling. Revenues drop significantly because people are traveling in different parts of the world now. Occupancy has been lower because people aren't really going to a lot of these staycations, as we call them, where they just drive 20, 30 minutes outside of their market and stay somewhere. Now they want to experience different places. Money's a little bit tighter, but we're going through a bit of I don't want to call it a recession, a bit of a tough time in the market, and people are holding on to their money and not really spending like they used to. Back when the government was handing out stimulus checks, everybody had money to spend. Right now, people don't have that kind of money. Booking windows have changed. For this, we were actually seeing bookings come out 2 to 3 months in advance because people were planning their trips out. And now we're seeing 2 to 3 weeks and even very last minute bookings because people are booking last minute. We're seeing that they're not really planning trips. You know, some money comes in, maybe they have a free paycheck and they go out and they'll book a trip and a plan to go somewhere the day up. And it's happened. I've gone a ton of last minute bookings in some really sought out locations like San Diego, Joshua Tree, and it's just the way people are booking now. So we got to stay vigilant of that, and maybe even incentivize some offers further out for people to book further out and get our places booked out a little bit better. Now, this is something that I have noticed only for mid-scale and below type properties. For the mid-scale and below type properties, people aren't really traveling to or flooding to Airbnbs or vacation rentals anymore. They're going back to the hotel model, and it just makes sense. I just read an article where even what's his name, Brian Chesky, the CEO of Airbnb, said that hotels are the future, and they're even focusing on trying to get hotels onto the platform. Put it this way: if you pay $150 for an Airbnb with no amenities, it's just a place to stay in an apartment complex, or you pay $150 for a hotel with the pool, concierge service, early luggage drop off, room service, a bar downstairs, which one would you prefer? Right? It's a no brainer. Daily cleanings and no cleaning fee. I mean, just that's the way people are. You're saving money, you get a better experience, and why would you book someone's Airbnb for the same cost if you can find a hotel? Now, if there's no hotels, obviously, you know, you're in a good market and people will book your Airbnb, but it just doesn't make sense. That's the way people are going. Now, on the flip side, the luxury market really hasn't changed. This is important to note because if you're the investor trying to get into short-term rentals and you can afford or have some money, or an investor that can come in with you and you can get something a little bit more expensive in the luxury market, we've actually seen a rise in occupancy, a rise in revenue, because in the luxury market, competition is scarce. A lot of people are leaning more towards experience-based locations with high-end amenities, and the luxury market has benefited from it. Now, this doesn't mean you're going to find a good price house in the luxury market. You might have to go into a luxury market or into a market and provide a luxury product, which means you're going to have to invest in some amenities. We have some properties still in Joshua Tree that we've made ultra luxury. We've added pickleball courts, saunas, jacuzzis, day beds, swings, hammocks, bocce ball courts, tennis court, basketball court. I mean, we've added a ton of stuff, glamping domes for people to stargaze at night, and we've made it exclusive to where people want to go there and not leave with large groups. Now, one of the big things is luxury markets are typically usually large properties. When you have a large property, people tend to travel with big groups, and when you travel with a big group, you can spend a little bit more money. And what do you look for? You look for a larger property. If I'm traveling with my fiance, I'm not going to book a five bedroom home, but I'm also not looking for a very high end luxury product. I'd rather stay at a hotel. But if I'm traveling with a group of 10 to 15 friends, I'm going to look for a property where we can all stay together, and it's going to be a little bit more expensive. It's got a bunch of great amenities, but we're going to save costs because we're splitting the cost 15 different ways. So back to my point, luxury market with large properties, high-end amenities have actually seen an increase in revenue and occupancy because of that. Now, if you're getting into this real estate short-term rental world going into this year, at the end of the year, a lot of investors typically buy at the end of the year because they need the tax cut, right? There's still tax incentives. Short-term rentals still has some of the best tax, what we call loopholes out there. Now, guys, I'm not a CPA, right? This isn't legal advice, but I do talk to a lot of CPAs, and I have investors that invest with me in short-term rentals because we can offer very high tax depreciations. And now that the big beautiful bill has passed, we get 100% bonus depreciation. Now, there's a lot of work that has to get done if you're the investor. So if you guys are thinking of going that route, or if you just want to invest in a short-term rental for the tax loophole, I'll make an entire episode for that. But just make sure you do your research, because it's not as simple as buying the property and taking bonus depreciation. You have to be very, very involved in the day-to-day. Certain number of hours have to be met, etc. But that's something to think about going into quarter 4. If you're the entrepreneur or the operator doing the work and you have an investor and the investor needs a tax write-off, the investor has to do a lot of that work with you in order for them to qualify for that write-off. But it could be very beneficial to you and to them, and you can get into the market with very little or no money out of pocket. And it's a win-win for you and your investor. Now, if you're the investor going in with your own money, just make sure you're purchasing the right way, right? We're actually buying stuff creatively. I don't focus on any on-market deals anymore, just because unless I'm going to get a killer deal on something that's a huge value add, I won't touch. We're buying creatively to avoid the high interest rates. Talking about those 2 Joshua Tree properties, we bought those at $1 million each. I have a full YouTube video of that coming out, if it's not already out at the time of this recording, talking about the details on that property. But it was 2 homes on 1 lot. We bought for $1,050,000 at 3% interest only payments. That means I'm paying about $23.75 a month on properties that are doing over $11,000 a month in revenue, which is killer, right? Because my cost of debt is significantly low. We're also building to keep lower mortgage rates. So we're building properties at 65 to 70% ratio of the owner, the value. Sorry, I'm losing train of thought there, but the value of the property we're building at 65 to 70%. And so that allows us to have a lower loan, which in turn means a lower monthly payment, right? If it's a property that's valued at $1 million and we only have debt on it for 650, 700,000, my mortgage is going to be significantly lower. And that $1 million value of that property could bring in a higher nightly rate because of the amenities that we've added. We're only doing, and I suggest all of you only do, experience style locations, properties that you can add amenities to, and locations that have amenities or places to go to, right? Things like outdoor areas, tree houses, pools, outdoor jacuzzi, saunas. I've seen some beautiful cliffside homes that have just what we call $1 million views that are 20 minutes from the park, a national park, and 20 minutes from the city. They're in the middle of nowhere. You're alone, and you just have an amazing experience with you, your group of friends, and you don't have to leave the property because everything's been provided, right? So, for example, if you go to one of our Joshua Tree properties, the park's 15 minutes away, downtown's 15 minutes away, but you don't really have to leave the property because we have everything there for you, from coffee to drinks to pools to jacuzzis. I mean, literally, you'll never have to leave. You can just stay there and hang out, barbecue grills to do everything you need to for the weekend. Those are the type of properties you need to be looking for. The days of having a home in the city that looks pretty are gone. Competition is fierce. Hotels are coming back. People are now seeing that it's just not worth staying there. Something you guys should definitely be doing is tracking metrics. I want to shift a little bit to this because this is something that a lot of people don't do, and I do this almost on a regular basis. Pricing and revenue management is huge right now. It's back in when everybody was getting into this, Price Labs and Beyond Pricing and all these other pricing algorithm platforms. You could set your base rate, which is what you want to make on a monthly average nightly rate. You can set your minimum rate, which is the lowest you take on a nightly rate, and you can set it and you could forget it, and the algorithm would come in and do its thing, and some days would be more expensive than others. Those days are gone. Revenue management and pricing management is still essential, but you have to manage it on top of that. You have to watch it closer than before because, again, booking windows are changing. So these algorithms haven't kept up, and they're not, to be quite honest, my experience, they're not doing a very good job catching that. In some of my properties where the booking windows was 3 months in advance, we're now seeing a month and a half in advance, and it's just so overpriced 3 months because the algorithm still thinks that people are booking 3 months out. So it overprices that's no longer the case. And so we have to come in and see what those rates are at. I mean, I'm seeing rates where today would be $150, and in 4 months it's $750. And I'm like, whoa, no one's going to book this place for $750 4 months out just to secure the place. That doesn't work anymore. And so we have to come in and we have to add our pricing and on top of the algorithm. Now, what they provide is great feedback. It tells me, hey, this is what people are booking. I also know that in my market, based on my properties, I'm not going to get those type of rates even 4 months out, not anymore. And so we have to be able to watch it and be able to select those dates to make sure that those nights are being booked. You need to know your occupancy for the next 30 days. Always keep track of that. What are you at? Are you 100% occupied? If you are, you're severely underpriced. It could be a seasonal thing, or it could just be you didn't pay attention to it, or it could be some sort of event that happened that you missed. You need to make sure that you're tracking all of that stuff. We track upcoming gaps and we just adjust accordingly, right? If I see that we have 7 days from today, we have 4 days vacant on Monday through Thursday, I add special offers to significantly drop prices or incentivize people to book those dead days to make sure my properties are getting booked, and making sure that I'm not going to show up to that last minute bookings. If it's 7 days from today, we add the special offer to make sure that if the 7 days have passed and today is that seventh day, I don't have to drop my price to $100 to make sure it gets full and potentially bring in a bad guest and cause problems. So just make sure you're staying on top of that. Make sure you're tracking your occupancy, your daily average rate, your gaps to see how far you're getting your bookings. Okay. Now, I want to touch on city regulations quite a bit here, because I used to tell people, hey, if there's no regulations, it's good. Just coming with the mindset to prepare that at some point a regulation will happen and you're going to have to pivot. I recommend only operating in markets that are pro short-term rentals. Whether there's a permit that you have to get, whether there are taxes that you have to pay, whether there's only certain locations you can operate in, go to those, because you're already allowed to do it, and they can never, well, I want to say never because cities change their mind, but they will grandfather you in, and you have a parameter of where you could work from. Not, hey, there's no regulation, I can go in and nothing's going to happen. We're seeing right now people are getting fees for $3,000 a night, and I mean that'll kill you, right? That's $3,000 could be 2 months profit depending on the size of the home, and you have to pay it per night just because you're operating a short-term rental. Now, is it silly? Absolutely, it's silly. Cities are being sued. Just make sure you're staying on top of your regulations, know how you're allowed to operate, and make sure you follow the rules. Okay, I want to touch a little bit on the arbitrage side, because for those of you that are barely starting off, and I know a lot of you guys follow me because of the arbitrage stuff here, arbitrage, in my opinion, has significantly changed in terms of the revenue you can make, the profit you can make, and the type of locations you should be arbitraging. People ask me all the time, hey, are you still arbitraging? The answer is yes and no. I'll arbitrage if it's the right location, in the right market, and the right property. And the right property is key here. I will no longer take a unit or even a 10-unit building or even an apartment in a 10-unit building if it's just an apartment in a building within the city. I just won't do it. I'm looking for A-class buildings with a ton of amenities in the building. Does the building have a roof deck? Is there a gym maybe on the roof? Is there a projector up there for people to, host gatherings and hang out during the day with the pool? Is there a pool? Is there a jacuzzi? Is the pool heated? Some of these apartment complexes that I've seen even have their own podcast rooms, right? That we can provide as an amenity. They have infrared saunas in these apartments. I mean, some of these apartment complexes are really, really competing against each other right now to stand out against the competition, even for long-term rentals. And those are the buildings that I would look for if I were going to arbitrage. If you have a 10-unit building that just happens to be in downtown, or that happens to be near downtown or near an airport, just know that there are hotels that you're going to be competing with for the same nightly rate that offer a much better, superior service than you're going to be able to provide for the same nightly rate. And so if you're thinking of getting into arbitrage, make sure you're looking at that. Make sure you know what your competition is, and make sure what your nightly rate's going to be. I won't get an arbitrage deal if all I'm going to be doing is making $100, $150 a night, when I know that the hotel up the street is doing the exact same thing with a much better service. It just doesn't make sense. But if you're finding A-class locations with all these crazy amenities and they allow your guests to use it, and you have full permission to arbitrage, and you know that you're going to be charging $250 a night, and your rent's two to $3,000, I mean, you're going to crush all day long. And so I would suggest go after those. Now, it's a lot of information, guys. This was kind of an intro telling you guys where the show's going, but also wanted to add some value by giving you guys my perspective of where the short-term rental market currently lies. Something I did not touch on is midterm rentals. Everybody out there knows midterm rentals are fantastic. I will touch on this and say they're just a ton of work. You have to build really heavy relationships. You have to go after the companies. Otherwise, you're just putting your house on Airbnb for 30-day minimums, and you're not going to get the rates that you're demanding. Travel nurses are no longer getting paid what they used to get paid post-COVID. Maybe I'll do an episode on midterm rentals after this, but just know it's also a very different market. It's shifting very drastically. If you guys are thinking of buying a property for midterm rentals, do some serious research and check on how serious the demand is in that market. Anyway, with all that being said, if you like the episode, please like, subscribe. Again, it's now coming up on YouTube under my Rafa Loza channel. And if you're listening to me on Spotify, iTunes, wherever it's at, it's staying under the Big Break Show. Going forward, we will be going solo. Love you guys. I'll see you guys on the next one.